Hi class, in this video, I'm going to go over chapter 32, the macroeconomic theory of an open economy. Now, personally, I don't use this chapter in my own class because I believe this is a topic that belongs to the intermediate class. So this video is actually by special request for you guys online. All right, so let's get started. Now, guys, just a disclosure before I continue. So I don't like how the PowerPoint is set up for this chapter. So I'm going to be skipping some slides in the PowerPoints, okay? All right, so let's get started. So first, let's talk about open economy. So open economy was mentioned in the previous chapter, chapter 31. Now, for this chapter, we're going to look at two tables or two models. It's the model for the loanable farm market and also the market for the foreign exchange market. We're going to see how these two markets are interconnected with something called an NCO, net capital outflow. Now, this was briefly touched on in the previous chapter. I'm going to go more in detail in this chapter too. Okay. All right. So first, let's look at our loanable farm market. Now, for the loanable farm market, this is the market where company and consumer go to save money and then borrow money from. So this equation here is very important. It's the saving equals to investment plus net capital outflow. Now, guys, when I learned this concept, almost 20 years ago, I was so confused about this equation here because that doesn't make any sense to me. But this is how I think about it. So this equation here, the S here stands for saving. So this is your national saving. This is the supply side of the equation. So this is how much money we're supplying into the market. And then on the right side, the I plus NCO, that is the demand side of the equation. That's how much we're demanding money from the market. So again, saving is the supply side, so how much money we're supplying to the market. And then the I plus NCO is your demand side for how much money we want to borrow from the market. So this equal sign is not a hard equal sign, so it doesn't mean that the saving always equals to I plus NCO. Especially when you have a change in the interest rate, this wouldn't equal anymore. Okay, so don't think this as 1 plus 1 equals to 2. Think this equation more like something like I'm telling you, my wife always loves me, right? So it's only true depends on certain conditions. So same thing over here. So this equation is only true depends on certain conditions. So for example, this is only true whenever you're at the equilibrium of your interest rate. But whenever the interest rate is away from equilibrium, so either too high or too low, then this equation wouldn't be true anymore. So let's suppose the interest rate changes. Now, one more thing. First of all, let's talk about this I and NCO. So I is your investment. Now, this investment is then for your domestic investment. So which means for all the money we want to borrow, how much of the money are borrowed by our domestic economy for our domestic purposes. So this would be, company want to buy a new truck, company want to expand the business. So how much money our domestic economy want to borrow, that's represented by our I. Now the NCO representing the money that's going out of the country. So how much money the foreigners want to borrow, or how much money that we want to borrow for our foreign transactions. So let's suppose you want to invest in a foreign company, or you want to buy stocks in a foreign market. You want to buy some mutual fund in a foreign market. So those would be called NCO, the net capital outflow. So money going out. So again, I is for money that's invested in this economy. NCO are the money that's going to be invested in other economy. Now let's go back to this over here. Let's suppose that this real interest rate changes. Let me show you how this wouldn't be equal anymore, right? So let's suppose let me use this. So let's suppose we have an increase in the real interest rate. So interest rate goes higher. Let's just suppose it's increased to 25% interest rate now. Now that is very, very high. So if you're a consumer who want to save money, then at a higher interest rate, you want to save more money, right? But on the other side, it's not the same anymore. Now, for investment, so if I'm a business, I want to borrow money to expand my business, and then I need to pay a 25% interest on the money I borrow. That's very expensive now, so I probably don't want to expand my business anymore, right? So the domestic investment will go down whenever you have a higher interest rate. Now for the NCO, the net capital outflow. Now the net capital outflow, that is your outflow minus your inflow. So outflow is the money going out, inflow money coming in. Now if I'm a domestic investor and I see that in my country, I can earn a 25% interest rate on my investment. Now that's pretty high. Do I still want to take my money out of the country? Probably not, right? So I wanted to keep my money in the country. So at a very high interest rate, we're going to see a lower output of capitals. Now, at the same time, if you have other investors in other countries, let's say investors from Japan, investors from Europe, they have a lower interest rate over there, but they see that America have a higher interest rate at 25%. What do they want to do? They want to put money in our economy, invest into our saving account because it earns a higher interest rate. So you're going to see an increase in our capital inflow. So a lower outflow, increased inflow, you're going to see a lower net capital outflow. We got a problem, right? Because for this equation, on the left-hand side, we have an increase. On the right-hand side, we have both decreases. So they're not the same anymore. So that's why this equation, this equal sign, is not a hard equal sign. That whenever its condition changes, this will change as well. So in this case, when the interest rate goes up, what you're going to see that your domestic saving will be more than our investment plus NCO. Okay, and then vice versa. If by the way, there will be a surplus of our money available for lending. So this is like your whenever the price level changes, how will that change between your quantity supplied or quantity demanded, right? So when the price level increases, you're gonna have a surplus, and vice versa. If your interest rate goes down, you're gonna have a shortage. So the interest rate here, the real interest rate, is just the same thing as your price of the good. Okay, so whenever price goods changes, you're going to have a surplus and shortage. Same thing over here. So real interest rate changes, you're going to have a surplus and shortage of loanable fund. Okay, or money available for lending. That's loanable fund. All right, so we talk about that. We talk about this too. Yeah, so guys, I'm going to skip some of the slides over here. We talk about this. Yes. To be honest with you, the slide for this chapter is a little confusing, so I'm going to skip some of them. Okay, that talk about it. Okay, so let's talk about it too. All right, so let's look at the graph. So for our supply for loanable fund, this is our national saving. So the S in the equation is the supply curve, and the demand for loanable fund, that's your investment plus your net capital outflow. So that's going down. Okay, so just like a regular supply demand curve, supply going up, demand going down, and then they have equilibrium. And for this equilibrium, this is your equilibrium real interest rate. Okay, so that's the interest rate set in the economy. All right, so that's the first model. The second model, we're going to look at it, is going to be our foreign currency exchange. So this is the market for foreign currencies. Now, for this market, the foundation, the equation that set up everything is this equation over here. The NCO equals to net export. So remember your equation for net export. So net export, by the way, this is like a chapter 10, is your export minus import, right? That's your net export. So for this equation here, we're going to say that your NCO, the net capital outflow, is equal to the net export of the economy. Now again, this equation here, don't think the equal sign as a hard equal sign. This is only equal whenever the conditions are met. Now, again, this will be the supply side and demand side for the market. So for the foreign currency exchange market, think about whenever we try to change money from US dollar to something like a Japanese yen. That's the foreign currency exchange market. So where people go exchange one currency for another currency. So the NCO over here, this representing the supply side of this market. So that's your supply. And then the net export here is the demand side of our market. Now, the reason why NCO is the supply side of the market, remember NCO, again, this is the net capital outflow. So it's how much money is going out. So if I want to take the money out of the country, let's suppose I want to take my money from US, which is dollar, to Japan, which is Japanese yen, I have to convert the dollar to Japanese yen first. So I will go to this foreign exchange market. So I'll go to the foreign exchange market. By the way, this is called it's actually called Forex, right? So foreign exchange market. So I'll go to the Forex market to exchange my money to a foreign currency. So I have to supply my US dollar, so supply the dollar to this market. Now, the net export, they're the people who need to have some US dollars. Think about foreigners who try to buy our stuff. So whenever we have this export to other countries, so if we sell, let's say we sell a SUV to Japan, now Japan had to pay for it, but to buy our SUV, they must have some US dollars. Now, when they don't have US dollars, they'll go to this Forex market to demand US dollars. So they want to convert the currency from Japanese yen to US dollar. So look at this dollar market over here. So for the dollar market, then we have, give me a color, how to choose my color. All right, so for the dollar market, we have the NCO, supply the money, supply US dollars into this Forex market. And then we have the net export, which is, company, people from Japan who want to buy an SUV from America. They want to demand the dollars from the Forex market. So this is the supply for US dollar, and this will be the demand for US dollar. Okay, so again, this equation here is only right whenever the conditions are met, but don't think this as a hard equal sign. Okay, so this is supply and demand, and only at equilibrium when that your NCO will equal to your net export. Okay, all right. So a couple definitions. So know what's a trade deficit. So trade deficit is whenever your net export is negative. So your import is more than export. That's called trade deficit. Now currently America will have a trade deficit, okay, because we have too much import and not enough export. All right, so we talk about so your whenever we graph this, so we draw the line, so draw the NCO equals to net export. Whenever we draw the graph for the Forex market, the supply curve, which is NCO. Now on the vertical axis, it's not a real interest rate. It's not a price level. This is called a real exchange rate. Now exchange rate is how much of your currency can exchange for other currency. That's called exchange rate. The higher it is, it means the stronger your currency is. And then that's called appreciation. Now, if your currency exchange rate ever goes down, that's called depreciation, right? So sometimes we say, dollar today depreciate by 5%. That means the value went down by 5%. So when you draw the supply curve here, so supply again is our NCO. Now NCO is only influenced by the real interest rate, not by the exchange rate. So when you draw the NCO will be independent of our exchange rate. So NCO will be a vertical line that's going up like this, and that's our NCO, which is the supply curve. Now for the demand curve for net export, this is just like any other demand curve. Demand curve will be downward sloping. Net export. So for this downward sloping net export, we say that whenever exchange rate is high, you're gonna have a lower level of money needed for net export. Whenever the exchange rate is low, you're gonna have a higher, so lower exchange rate, you're gonna have a higher level of net export. Now, this might not make much sense, but guys, there's an article that's inserted in your textbook for this chapter. It's talking about a strong US dollar. I really strongly encourage you guys to read it. So about strong, can't spell, US dollar. So normally we all believe strong money means good, right? Strong money means your money is more valuable, it's more appreciating, it's good. But in the market for net export, a strong dollar can be very, very bad. Because again, your net export, so again, net export equals to export minus import. Now, if our dollar is strong, that means everything you produce at home is more expensive, because at home we pay our employees, pay our resource with US dollar. So at a stronger US dollar, that means now everything becomes more expensive to produce it, so price level goes higher, right? So stronger dollar means a higher price level, so everything is more expensive at home. So therefore, your export will go down with a strong US dollar, because everything is more expensive in America. But a stronger dollar means, relatively speaking, everything produced overseas are cheaper now, right? So what do? So we have our money worth more, and then we can buy more from other countries. We do buy more from other countries. So with a strong dollar, your import goes up because you can buy more stuff from overseas. Now lower export, higher import, you're gonna see a lower net export. That's why between your exchange rate and also your net export, you have an inverse relationship. At a higher exchange rate, you have a lower net export. At a lower exchange rate, you have a higher net export. Okay, so don't believe that strong dollar is always good. The strong dollar can be bad in some situations. All right. Okay, so we talk about this. Talk about a higher exchange rate, lower exchange rate. Talk about that. All right. So this is the graph for your market for foreign currency exchange market, or the Forex market. That's just easier to say it. So Forex market. Your supply curve. This is your net capital outflow. So NCO. And the demand curve. This is your net export. Okay. And then when they meet, only at this intersection, you're gonna have your NCO is equal to your net export. Now anywhere else, let's suppose we're somewhere over here. That's supposed to be a straight line. So somewhere over here, then your NCO will be more than net export. Okay, so this equation here is only true at equilibrium, and then at equilibrium, this will decide how much our real exchange rate is. So how much is the value for US dollar, the currency rate. All right, so far we talked about these two models. So we talk about our loanable fund market, and we talk about our foreign exchange market. Now, if you guys have really paid attention, I hope you have, that between the two there is a common factor, right? So our equation for the loanable fund market is saving equals to investment plus net capital outflow. And then the market for our Forex market is your net export, or NCO, equals to net export. Now notice that between both of these two equations here, they share one common term, the NCO, right? So this is the link between two equations, and this is the link between two markets. So which means that for these two markets, they are linked heavily together. Whenever one market is changed, it will impact the other market too. Now we can actually draw all two graphs together, not into one panel, but into two separate panels, but linked together. Now, if we oh look, that's a happy face. I just noticed that, right? So that's a guy with glasses, right? And then and a happy face. Oh my God, I'm so good. Okay, all right. So about that, forget about that. For NCO, when I look at the market for NCO, so the net capital outflow. Now again, this is influenced by our real interest rate. Okay, so interest rate. And then this will be this will be the amount of net capital outflow. So for this, if you graph this between real interest rate and then net capital outflow, you're gonna see an inverse relationship. So NCO is something going down, because at a higher interest rate, again at a higher interest rate, our domestic investors will keep money at home. So at a higher rate, so when the rate is, let me use this. When the rate is high, our outflow goes down, and the inflow goes up, and therefore your net capital outflow will go down. Now vice versa at a lower interest rate. So imagine if a market pays a 0% interest rate, then I don't want to keep money in a market anymore. We're going to move my money to other countries which pay me a higher interest rate. So at a lower interest rate, the capital outflow will go up, and then inflow. Now those foreign investors want to put money somewhere else too. So inflow goes down, and then net capital outflow will go up. Okay, so that's why between your interest rate and then your net capital outflow, this is the inverse relationship. Okay, all right. So let's see how we can connect all panels we just learned. Let's draw the first one. So we have the market for loanable fund, right? So we have this supply for loanable fund, and this is the interest rate, and then the demand for loanable fund, this would be the investment plus net capital outflow, and then at the intersection we have our equilibrium interest rate. Okay, now this equilibrium interest rate will impact our market for NCO, the net capital outflow. So at the next market, the NCO, so again, this is the interest rate, the NCO market, this, let me use different color, this will decide how much the amount of NCO we have. Now, the next panel we're going to show is the Forex market. So let me draw here. So this is the Forex market. In the Forex market, the equilibrium, the exchange rate is on the vertical axis, and over here, let's just say the dollars exchanged. How much quantity we have for our NCO, not NGO, NCO. How much NCO we have? That's our supply side for the Forex market. Remember the equation for it? It's your NCO equals to the net export, and this is the supply side. So this quantity of NCO is actually our supply for our Forex market. So that's your supply for Forex market, and then again the demand for Forex market, that will be your net export. Okay, now you see the links over here, right? So we start with our loanable fund market. The interest rate will impact how much our net capital outflow is, and the net capital outflow will impact our real exchange rate, because that will determine how much the exchange rate is. So that's how they're connected. Okay, all right. So okay, we talk about this, we talk about that. So guys, that's why I say this chapter PowerPoint is not very good, because we can, everything here we just talk about it, and then trust me, don't try to avoid this PowerPoint because the PowerPoint is not very good. Okay, all right. So all right, we can also use the 3 panels here to demonstrate 3 scenarios for this chapter. So like a 3 extension for this concept. The first extension is called a government budget deficit, or deficit. Now, government budget deficit. Government is like any other household, that whenever we spend too much money, so whenever you're spending by the government is more than the government tax revenue, we have a government budget deficit. So if you look at U.S. economy, we've been having budget deficit for last almost 25, 26 years, because the last time we had a surplus, it was when the horny guy was in presidency. I'm sorry, Bill Clinton was the president. Okay, all right. So so this is the budget deficit. But when you have a budget deficit, this will impact our 3 panels over here. Let me show you how this will change it. Okay, so let me draw. I'm gonna draw all this. This is a lot of work. So the loanable fund market, we have our supply for loanable fund. Stupid. Demand for loanable fund, supply for loanable fund, and then we have our interest rate. And over here with the interest rate, we have our NCO. And this is your interest rate. This is the interest rate. And then with the NCO, we'll have our Forex market. And this would be your net export. And this is exchange rate. Let's call it star. Okay. All right. So whenever government has a budget deficit, that means we don't have money anymore. So we're going to reduce our national saving. So saving goes down. So when saving goes down, by the way, for national saving equals to the public saving plus the private saving. Private, this is your consumers, your individual household. Public, this is the government, right? So whenever you have a budget deficit, this public saving will go down and national saving goes down. So I'm going to show a decrease of supply of a loanable fund. So supply will be shifting to the left. So let's call this S2. Now at a lower supply level, we have a new equilibrium. So there's a higher interest rate, right? So interest rate goes higher. Now when the interest rate goes higher, this will cause a change in our net capital outflow. Oh, that looks bad. So that's your new equilibrium for net capital outflow. And then go down. This reduce our net capital outflow. Sorry, that's straight line. Okay. Reduce our net capital outflow. And then which means we're going to have a new exchange rate. Let's call this E2. So exchange rate is increasing. Okay. So with a government budget deficit, so budget deficit will lead to a decrease in national saving or public saving. This will lead to an increase of the real exchange rate because government needs to borrow more money. And then increase in real exchange rate will lead to a decrease of our net capital outflow. And then in turn, this will lead into a decrease or increase in our exchange rate, and which means that at the end, your net export will go down because net export before was over here, but now it's over. Give me color. So before this is 0.1, and now this is 0.2. So we'll have a lower quantity of net export. Okay, so a budget deficit will hurt the overall economy because it will lower our net export. All right, so over here. So we talk about this. Okay, so now what's a crowding out effect? This is definition in many of the chapter textbooks. So crowding out effect, it means whenever the government become too big a player, too involved in the economy, it will change the dynamic in the economy. So either increase the price level, or in this case, increase the interest rate. It will push many of the private sectors out of the market. So for example, now back to this whole transition here. The part that's gonna make this, how do I make this go away? Okay, all right. The part that's going to have this crowding out effect is this higher interest rate. And this will cause a crowding out effect. Because whenever government need to borrow money, so when government borrow money, let's write this out. So government borrow money. They are competing with our companies who are also borrow money. So imagine there are only so much money available in the market. So whenever government borrow more money, this will cause our interest rate to go higher. So interest rate goes up. Now imagine it changes from 5% to 10%. Now at a higher interest rate, it will cost company more to borrow money. So which means some of the company will actually reduce how much money they borrow. So we call this a crowding out effect. So they are being crowded out. Okay, so again, government borrow too much money, interest rate goes higher, company borrow less money, and that's called a crowding out effect. Okay, all right. So that's bad for investment. So investment goes down, and also is that all these changes relating to a decrease in net export. Right, so decrease in net export. So net export also goes down, which means that you might have a lower real GDP. Right. Okay. All right. Okay. So we just talked about this. Now the next concept, the next extension for this concept is the trade policy. That whenever our government try to influence the trade market, so this will be the import-export market. This can also be illustrated by our 3 panels here. Now for this trade policies, there's basically 3 types of trade policy government can use. So first, we heard this one before, it's called tariff. So tariff is an import tax. Next one is a quota. Quota is like a hard limit of how much our import is. So suppose our government says that for the entire year, we can only import 200 cars. We can only import 500 teachers, right? So the number we put on how much we can import, that's called quota. And then also we might have something called a voluntary export restrictions. So try to restrict how much our number of export is. Okay. All right. So let's take a look at how this will impact our economy. So again, we can use our 3-panel graph over here. You know what? Let's use the one in the PowerPoint. The one in the PowerPoint is actually pretty clear, and this is a very easy transition too. All right. So first we start with an import quota. So try to limit how much our import is. Now when you have import quota, so we're going to lower our amount of import. So there's no room to write. So import quota will lower your import. Now when import is lowered, that means your net export will be higher. So what you want to see, you're going to see a shifting of our demand for Forex market will increase. Now when it increases, it will increase our exchange rate. So exchange rate goes from E1 to E2. Now, however, because your supply for loanable fund market, or supply for Forex market is our NCO, and it's vertical, so it doesn't change at all. So this change in the net export market has no effect on the other 2 market because our NCO remain the same. The supply for Forex market doesn't change. So in another word to put it, that whenever you have this restriction on the trade policies, especially import tariff or import quota, this will have very minimum impact on the macroeconomy. And let me show you why that is. Okay, so now remember our net export is your export minus import. Now let's suppose our government decide we're going to put a tariff, tariff on all the cars we import from Japan. Now, if we put a tariff on all the cars import from Japan, that means our overall import for the economy will go down, and then therefore your net export will go up. Now, when the net export goes up, so at a higher level of net export, this will actually leading to a higher exchange rate. So exchange rate goes higher. That means you're going to have a strong US dollar. Now, in the car business, your US car producers, they are very happy, right? Because now they have less competitions from company in Japan because there are less number of cars coming from Japan. But in other market, this might not be the same case anymore. Think about our airplane business. So airplanes. Now for airplanes, we do have US will have the biggest airplane company in the world, which is Boeing. So Boeing does a lot of international business. Now the biggest competitor for Boeing is Airbus, which is based in Europe. Now with a strong US dollar, that means with all the airplane Boeing produced, they're getting more expensive now, right? Because they produce in America. So with a strong dollar, for Boeing's export of airplane, airplane will go down because we couldn't export them anymore, right? So even though you have this this positive initial impact from this tariff on cars, that our net export will increase, initially, but overall this will cause a change in the real interest rate. Real exchange rate. So U.S. make good more expensive, and then our export go down again. So the net result, that when the export goes down, these two, they might cancel each other out. So the net impact on the net export might not be positive. It might be the same, or even might go down a little bit, because if your export goes down by too much, right? So that's why whenever you have a change in the trade policy has a very little impact on the macroeconomy. Can't spell Marco. Because the market economy is hard to change, because our net export at the end might just stay the same. Now, however, it will have a huge impact on the microeconomy. So especially for car market. So for cars, our companies are happy. But for the airplane market, the companies like Boeing, they're sad, right? Because they cannot sell that many airplanes anymore. So it has a bigger impact on the microeconomy, but a very minimal impact on the macroeconomy. All right. The last concept for this chapter is called a capital flight. Now, capital flight, this is imagine that if your investors are all worried about their money and they want to pull the money out as soon as possible, so getting the money out of the country all at once, that's called capital flight. And then one of the biggest reason for that might be any type of political instability. So if a country goes through big changes all of a sudden, the investors don't feel very secure about the investment, they will try to pull the money out, and this process is called capital flight. And then we can use what happened in Mexico, for example, in 1994. So 1994, because all the political instability in Mexico, there was a capital flight happened in Mexico. So let's see what happened in the economy. Let's use this panel again. So what happened is that whenever the investor put the money out, you saw a huge increase in our NCO. So in Mexico, there was an increase in NCO. Now when the NCO increases, this caused the interest rate go up, right? And also at the same time, in the loanable fund market, remember the demand for loanable fund, that's your investment plus NCO. So if your NCO is increased, this will cause an overall increase in our demand for loanable fund. So demand for NCO goes up, a demand for loanable fund goes up, and again, you have a higher interest rate. Now, this higher interest rate is very important. I'm going to come back to it. And then on the other side, in the market for foreign exchange market, more NCO being supplied to the market, that means we have more supply of the foreign exchange market, so more pesos in the market that to be exchanged for other currencies. So more supply holding demand constant, then I'm going to see a lower exchange rate. Right, so exchange rate getting cheaper, that means peso become worthless. Now, if you just look at this, doesn't look that bad, right? Because we do have an increase in the real interest rate and a decrease in the exchange rate. So maybe your savers are happy in the economy because they can get a higher interest rate. At the same time, your companies might be doing pretty good because with a lower exchange rate, their net export will increase. But however, that wasn't the case in Mexico, because this was what actually happened because of those conditions changed. Now, first, let's talk about this increase in the real interest rate. Let me just write it out. It looks more important when I write everything out. So real interest rate. Now, except I have a terrible handwriting. So when the real interest rate increased, so getting more and more expensive, what really changed is the domestic investment. So for domestic investment, now that's heavily depends on the real interest rate. So whenever the real interest rate goes up, your domestic investment went way down because it costs the company more to save the money, more to borrow money, to borrow less money, and then domestic investment goes down. That's bad for business, right? Now next, whenever the exchange rate changed, Oh my god, see, that's why I don't write everything out. Exchange rate. So whenever the exchange rate changed, especially went down, now even though it's pretty good for the net export, but it's very bad for domestic consumers. Now there is a say about Mexico. It says Mexico is too close to, too far away from God and too close to America, right? So this is what it means in the economy. Big part of the Mexican economy depends on U.S. economy. So Mexico actually do a lot of trade with U.S. economy. Many of the good consumed in Mexico actually produced in America. So with a lower exchange rate, so peso is getting cheaper now. That means everything they bought from America just become more expensive. So with a lower exchange rate, they actually increase the inflation in the economy. So inflation went way up. So therefore, the consumers are worse off. So you have two sides over here. Business are worse off because of higher interest rate. Consumers are worse off because of high inflation. So that was very bad for the Mexican economy. Now, this, even though, so this might be a zero-sum game, right? So if your Mexico economy was getting bad, that means the U.S. economy must be getting pretty good. But it was the case. So we saw some changes in the U.S. economy. So there was a fall in the net capital outflow in America because there's so much money coming into America. So net capital outflow went down. So dollar appreciated a little bit. So we had a little strong U.S. dollar. And then this also caused our interest rate go down. But the impact to America, to U.S. economy, it is very small. Even though it was a huge change in Mexico, but Mexico relative to America has a smaller economy. U.S. is a bigger economy. So this change had a very little impact on the U.S. economy. Just imagine if I get into a fight with Mike Tyson, right? So we both punch each other. When I punch him, it feels like nothing. When he hit me, I probably finished, right? So same thing over here. So imagine if U.S. is Tyson and then Mexico is me, right? So a huge impact in Mexico means almost very little changes in U.S. economy. All right, so guys, that's it for this chapter. So hopefully this helped you understand the topic. Have any question, let me know. Okay, see you later. Bye-bye.